Welcome to Money Minds Media, your channel for navigating the treacherous waters of the global economy. If you're feeling a sense of unease about what's happening, you're not alone. But what if I told you this isn't just another dip, another temporary setback? What if the very foundations of our financial world are trembling? Before we dive into the terrifying details, make sure you subscribe to Money Minds Media. Hit that like button and share this video with everyone you know. You need to hear this, and so do they, because what's coming affects us all. Forget what you think you know about past recessions. This isn't 2000. It's not 2008. It's not even the shock of 2020. We are standing on the precipice of something far larger, something systemic. The bubble isn't in one market anymore. The entire system is the bubble. And the terrifying truth? It's already starting to burst. You've probably seen the warning signs, even if you couldn't quite connect the dots. That infamous yield curve, the harbinger of recessions, just screamed a warning we cannot afford to ignore. The Nasdaq, a titan of the tech world, has already plummeted, signaling deep distress. And consumer debt? It's a ticking time bomb, more explosive now than even before the dot-com bust or the housing market catastrophe. The most chilling part? Almost no one is truly prepared for the storm that's gathering. Stay with us as we break down why this time the danger is unprecedented. Let's talk about something called the yield curve. It sounds technical, but think of it as the economy's most accurate fever chart. Normally, you get paid more interest for locking your money away for a longer time. That's a normal, upward-sloping yield curve. But when short-term government bond yields rise above long-term yields, the curve inverts. This unnatural state gets all the media headlines. But the real economic earthquake, the signal that the ground is about to give way, often happens when it reverts. When short-term rates fall back below long-term rates after a period of inversion. Why is this so terrifying? Because an inverted yield curve and its subsequent reversion has preceded every single U.S. recession since 1956. That's not a coincidence. It's a track record of doom. Consider the chilling history of the U.S. 10-year versus 2-year Treasury yield curve. A key comparison investors watch like hawks. It inverted back in 2000, right before the dot-com bubble imploded, wiping out trillions in wealth and countless jobs. It inverted again in 2006, a dark prelude to the 2008 global financial crisis that brought the world's banking system to the brink of collapse. It inverted in 2019, just before the COVID-19 pandemic triggered a sharp, brutal global recession. And now, in 2025, after a prolonged period of inversion, it has reverted. The most reliable warning siren in finance is blaring, right now. This isn't some obscure academic theory. It's historically one of the most reliable predictors of full-blown economic and market devastation. Typically, a recession follows the initial inversion within 6 to 24 months. The clock has been ticking. Why is this reversion so critical? It screams that the bond market, often called the smart money, has lost all faith in near-term future growth and believes the immediate future is far riskier than the distant one. It's a declaration that the economic engine is sputtering, overheating, and about to seize. This is the moment the market stops shrugging off bad news with blind optimism and starts reacting with raw, unadulterated fear. For ordinary people, this isn't just an abstract financial event. An inverted and then reverting yield curve can mean that interest rates on things like adjustable-rate mortgages and lines of credit go haywire, squeezing household budgets before the recession even officially hits. It signals that lending dries up, businesses can't get capital to expand or even operate, and the entire economic machine starts to grind to a halt. This isn't just speculation. It's a pattern etched in the painful lessons of modern finance, and it has just played out again, right before our very eyes. If you needed any more proof of how terrifyingly fragile our current financial system is, look no further than the market's recent violent reaction to renewed tariff discussions. President Trump's signature policy move for 2025, more tariffs, more aggressive trade talk, a chilling echo of past trade wars that destabilized global commerce, sent the market into an absolute nosedive. We're talking a nearly 20% collapse in less than 2 weeks. A brutal, swift shockwave. Think about what didn't happen to cause this widespread panic. There wasn't a Lehman Brothers-style collapse of a major bank, or a sudden credit crisis freezing the system. Corporate earnings didn't suddenly evaporate overnight across the board. The Federal Reserve didn't make some drastic, unexpected interest rate hike or policy shift. No, it was just one policy announcement. A single series of headlines was enough to trigger a market implosion of epic proportions, wiping out billions in paper wealth and shaking investor confidence to its core. What does this tell us in no uncertain terms? It screams that our financial system isn't robust and resilient. It's a house of cards built on a treacherous foundation of massive, unsustainable leverage, flimsy narratives spun by so-called experts, and absolutely zero shock absorption capacity. You simply don't see a market reaction that violent, that sudden, unless virtually everyone is dangerously exposed, all crowded onto the same side of a very risky, over-leveraged bet. Long the market, leveraged to the hilt, and utterly delusional about the underlying stability. This isn't a sign of a healthy, functioning market. It's the unmistakable sign of a system primed for a catastrophic, cascading margin call that could dwarf previous crises. There's a chart, a set of data points that should send shivers down the spine of anyone invested in the stock market, anyone with a job, anyone with a mortgage, anyone who buys groceries. It shows personal interest payments, the sheer amount of money ordinary people are forced to shell out every month just to service their ever-growing debts, compared to their stagnant wages. And right now, that ratio has skyrocketed past the already dangerous levels we saw at the absolute peaks of the 2000 dot-com crash and the 2007 housing bubble. Let that sink in for a moment. We are not just trending towards those perilous levels. We have already surpassed them. Consumers, the backbone of the American economy, are already dedicating a larger portion of their hard-earned income to debt payments than they were just before the 2 most devastating financial collapses of the last generation. This isn't a future problem. It's a clear and present crisis. This is a disaster unfolding in plain sight, often ignored by mainstream commentators, yet its implications are terrifying. Disposable income is vanishing at an alarming rate. There's less and less money for essentials, like groceries, for gas to get to work, for healthcare, for anything beyond desperately trying to keep the debt collectors at bay. Discretionary spending, the lifeblood of many businesses, is being choked off. Defaults are set to explode across the board. People can only stretch their finances so far before they snap. Mortgages, car loans, especially subprime ones, credit cards, student loans. A tidal wave of defaults is not just possible, it's becoming inevitable. Consumer spending, which accounts for roughly 70% of our entire economy, is about to plummet. When people are forced to stop spending, businesses suffer catastrophic drops in revenue. Profits dry up, inventories pile up, and mass layoffs begin. This creates a vicious downward spiral. And once that crucial domino falls, corporate earnings will be utterly decimated, sending stock prices, which are still often priced for perfection, into a prolonged and painful freefall. The most terrifying part of this unfolding tragedy? The recession hasn't even been officially declared by the authorities yet. And ordinary people, families across the nation, are already financially suffocating. They are maxed out, buried under mountains of debt, with little to no savings, no safety net, and absolutely no capacity to absorb another financial shock, whether it's a job loss, a medical emergency, or soaring inflation. You might be listening to all this, feeling a knot in your stomach and thinking, okay, things sound incredibly bad, but surely some sectors are safe? Surely this is somehow contained. That is a dangerously complacent myth. This time, there is genuinely nowhere to run, nowhere to hide, because the bubbles aren't isolated in one or two sectors. They are everywhere. We are living in the age of the everything bubble. Let's count the terrifying ways our economy is stretched to the absolute breaking point. A multi-front crisis in the making. Tech stocks and AI hysteria. We're witnessing a speculative frenzy in areas like artificial intelligence, with many companies valued at astronomical, logic-defying multiples based on pure hype and future fantasy, with zero actual earnings or viable business models to back it up. It's the dot-com bubble all over again, but potentially much larger and more volatile. The housing market time bomb. Prices remain locked at impossibly high levels in many areas, not because of genuine sustainable demand, but because inventory is artificially frozen due to homeowners clinging to low mortgage rates. This creates a fragile standoff that cannot last indefinitely. When it breaks, the fallout could be severe. The corporate debt mountain. Companies across numerous sectors are drowning in unprecedented levels of debt, much of it taken on when interest rates were near zero. Now, massive refinancing needs are looming just as interest rates are significantly higher. A wave of corporate defaults and bankruptcies is not a matter of if, but when. Runaway government debt. National debt has exploded to levels once thought unimaginable. There appears to be no spending discipline, no political will on either side to address this fiscal insanity, just an ever-growing mountain of IOUs that can never realistically be repaid without either massive inflation or devastating austerity. The consumer credit nightmare. It's a subprime disaster unfolding in real time, but this time, it's not just mortgages. Subprime auto loans with shocking default rates, maxed-out credit cards carrying crippling interest rates, the explosion of unregulated buy-now-pay-later schemes. It's a recipe for widespread financial ruin for millions. The bond market illusion. Once considered the ultimate safe haven, bonds are now a dangerous trap for the unwary. Massive duration risk, meaning bond prices fall sharply when rates rise, combined with still negative real yields, inflation eating away any returns, means bondholders are set up for potentially devastating losses in purchasing power. Every single sector of the economy is a tinderbox, saturated with accelerant, just waiting for a spark. Every supposed safe haven is already overinflated, dangerously crowded, and vulnerable. And what about the central banks, the supposed guardians of economic stability, the lenders of last resort? They are effectively running out of ammunition and credibility. Their only tools left seem to be increasingly hollow promises and the desperate hope of eventually cutting interest rates. But neither of those will work when inflation remains stubbornly persistent and public confidence has completely and utterly evaporated. The global financial system is more interconnected, more complex, and more fragile than ever before in human history. When one critical part breaks, the contagion will spread like wildfire, far faster and wider than most can comprehend. This isn't fear-mongering for the sake of it. This is a sober, data-driven assessment of the clear and present dangers that are not just on the horizon, but are already beginning to materialize around us. The information we've shared today is alarming, and it should be. But awareness is the first step to preparation. Don't face this uncertainty alone. Subscribe to Money Minds Media right now for ongoing analysis and insights to help you understand these critical times. Hit that notification bell so you don't miss our vital updates. Please, like this video if you found it informative. It helps YouTube show it to more people who need to see it. And most importantly, share this video far and wide. Your friends, your family, your colleagues. Everyone needs to be aware of the risks we're facing. Thank you for joining us on Money Minds Media. Stay informed, stay vigilant, and we'll see you in the next video.